please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
S Naren, the Executive Director and CIO, ICICI Prudential AMC, joins us now to discuss more about this. Naren, hi, good morning. You're a very interesting product. There's a lot of consumer interest here. So I want to start by asking you, for retail investors, why should I invest in this? And what kind of earnings, compounded annual growth do you expect for this basket as a whole? And how much return should investors expect?
I think what our market views, as you know, is that we are very positive on large caps relative to mid and small caps. The entire construct of Bharat 22 is significantly large cap. Most of the companies are mega caps. So from that point of view, I would say that it is in tune with our view that large caps have a much better outlook compared to mid and small caps. The second, clearly, if you look at the composition of the index, there are a few private sector companies, and other than that, we have strong public sector companies. And when you look at the valuations of many of the public sector companies, you will find that many of them are actually trading at pretty attractive valuations. And in fact, the price to earnings of this index is easily 30% lower than what it is of the Nifty. And many of them have return on equities which are reasonable, and some of the banks have gone through a big NPL cycle, and we think that the NPL cycle has just about peaked or is peaking in this period. So we think that the outlook for the next few years for earnings for the Bharat 22 pack is very significant. As you all know, the earnings expectation in the large cap index itself is 20%, and here there could be stocks whose earnings potential is much higher. Yeah. On top of all that, there is a 2.5% discount on the reference price, and because you have a 2.5% discount on the reference price, there is an intrinsic margin of safety when you invest in Bharat 22 because of that reason. And this combination makes it very attractive for retail investors, in my opinion, much more than it is for institutional investors. And we look forward to investors looking at it, particularly in the retail component and in the component where we have created, which is the fund of fund offer, where it's not necessary for someone to have a demat account.
Okay, Naren, good morning. My only problem with this fund is that it has a lot of power stocks, a lot of oil and gas stocks, where in election year there could be a lot of uncertainty. Your thoughts on the risk factors in some of these stocks?
If you look at power, actually the entire regulatory environment is based on a CRC 5-year period, which extends all the way till 2019. And these are all regulated return companies which have a lot of growth because of the fact that most of the private sector has not been investing in power, particularly thermal power, and the few of them who started thermal power plants, they're all actually moving out of this area. So I think the power sector, clearly I would say that the worries from a regulatory point of view have never been there, and we think that the entire down cycle in power utilities ended a few years back, and on a continuing basis we need more and more power, and that's why we are not really worried about it. On oil, frankly, till this point of time the government has not had any subsidies, and we don't have a situation where diesel has been controlled and a big diesel subsidy or a petrol subsidy or an upstream subsidy has been created. And there have been continuing statements from the government that they would not move back to a subsidy regime which existed between 2006 and 2014. So I think that means that if I would say that those sectors have got derated because oil has gone up, and that has an impact on the country. more than on these companies. We have seen some decrease in marketing margins, but I believe that these are all companies which have a very, very strong base, because it's very difficult to set up a nationwide oil product distribution network at this point of time because of the way real estate is, how difficult it is to set up pipelines. So I would say that clearly the risks on these areas are overstated, and that is one of the reasons why some of these stocks have corrected. But we would say that the opportunity clearly exists in Bharat 22.
Naren, morning. My area of concern is actually the banks. You've got 4 key names here: SBI, BOB, Indian Bank and Axis Bank. Now, these haven't been really the stalwart leaders of the rally so far, and naysayers will still argue whether the PSUs, I mean, even if there is a turnaround, whether the recovery is going to be far more slow. Axis, we are awaiting to see what the management change brings about. So, could financials weigh down the performance of the ETF?
Actually, if you look at our portfolios, we are clearly positive on large caps, which is the bedrock of Bharat 22. We are positive on power, which again is one of the important sectors in Bharat 22. We have been clearly very positive on corporate banks, and all the banks that are part of Bharat 22 are corporate banks, and we think that the corporate banks have seen a long downward cycle from 2010 to 2018, and all the NPLs that have actually come out. So I believe that we are actually at the bottom of the corporate banking cycle. And if you look at it, the banks which are part of Bharat 22 are the banks which have much more capital, and they are not capital constrained. They are not either PCA banks. So I would say that actually the outlook for the corporate banks in Bharat 22 is pretty good at this point of time, and it reflects our entire view of being positive on corporate banks, upstream oil, and power utilities, and we are clear believers that capital goods cycle is also likely to improve. So that's why it is very much in tune with our macro views that we have in our portfolios.
Okay, I'll come back to the Bharat 22 portfolio in a bit, but lest we run out of time, I just wanted to squeeze in a market question. The last time we spoke to you, you were a bit cautious on the market. You were recommending investors to go in for balanced funds, etc. After the kind of correction that we've seen, any change in your strategy at all?
I don't think there has been a big correction in large caps. I think we are 2% away from the highs. So I don't think we've had any big correction. We continue to think we are in a moderate return world, which is why a product like Bharat 22, which is focused on good value stocks and there is a 2.5% discount, becomes relevant. But I would say we are not believers in a big return world from here, at least not till US says I'm not going to increase interest rates, and which is why global markets have all, and we expect them to be volatile over the next 1 year to 1.5 years.
Okay. In that case, Naren, you reckon I mean, of course, these things are tough to time, but the high for the year may have been made, and considering the last year's returns, this year would be moderate, and the market would be in a bit of a range?
Yeah, we have been believers in a range-bound market from here, and we continue to think that for big returns to be made, Indian elections have to get over. US should stop increasing interest rates, US should stop quantitative tightening, and oil should come down from where we are to about $65 at least. So I think once one of these 4 plays out, then we intend to relook at our entire call and look whether there's potential for large returns. Otherwise, we are believer in lower returns, we are believers in large caps, and that is the kind of framework we have had, and which is why we were very keen on launching Bharat 22, because it's a large cap oriented fund and there is a 2.5% discount on reference price.